welcome to the 2019 WSC Group Post-Budget Briefing webinar. My name is Sarah Cox and I'm the National Administration Director at WSC Group. Today, WSC Group founder and CEO David Shaw will present an overview of the government's budget announcements together with the Labor Party's budget reply. Before I hand over to David though, just a couple of housekeeping items. Today there are two options for audio. You can either choose to listen in via your computer or device audio, or alternatively, you can listen via telephone. If you are in a location where you may be at risk of internet dropouts today, we do suggest that you do use the telephone option. Now, there will be time for brief general questions at the end of today's presentation. However, more specific questions will be taken offline and then one of the helpful team will get back to you. Now, this webinar is being recorded, so if you do have to leave us early today, it will be made available online after the session, so keep an eye on our social media channels for notifications. All right, again, thank you for joining us today, and I'll now hand over to David.
All right, thank you very much, Sarah, and welcome everyone, and thanks for taking some time out from your busy days to go through with me basically the budget document which came out earlier this week, and also Labor Party budget reply. What I've tried to do is with these slides that we're just about to go through is really look at essential tax changes as opposed to looking at probably other aspects of the budget. And it's a really significant budget because it's a pre-election budget. And also because of the length of time between the budget and the general election coming up, there's been lots of announcements made by both sides of politics, and we could see some of the most significant tax changes that I can remember probably in the last 20 years. So, you know, if we can get our minds around the ramifications from a tax point of view, we'll have achieved our purpose for today. So a few things, just a general advice warning there. You can see I was on the previous page. Obviously, this is general information, specific information. You need to talk to us specifically about your situation. So, look, the agenda we're going through today, you can see the 2019 budget document. So we're looking at just some general things in the budget, and then we're also then dipping straight into tax and some of the announcements which have been made, really important because some of those announcements have an immediate positive impact, which is great. And we'll also go through some of the other items that might be of interest to employers. For example, you can see there's some of the things like incentives for apprentices, etc. Then what we're going to do is we're going to then have a look at Labor's budget reply and other announcements, because there's been some other important announcements in relation to future changes in negative gearing, capital gains, which will obviously affect our property investor clients long term, and also our business clients as well. So what I've tried to do is make things, as I said, as simple as possible, take you through the facts and figures and give you an idea of both the budget changes and also also the Labor budget reply as well. All right, well, let's dip straight into it, and you can see there, obviously budgets are, as we know in business, are always a projection, probably the next year, and so you know, the budget always has to look forward to where the economy is going to be in coming years. So you can see the first thing the budget always does is look at the history of unemployment, and that's tracking at about 5% at the moment. So the projections are based on around about 5% unemployment going forward into the immediate budget period over the next few years. So you should just be aware of that. You know, if unemployment goes up, obviously the budget will probably be adversely affected, of course. Just to the next slide now, if you can see also when we look at the budget in the last 10 years and the next 10 years, it's fair to say that it's been a really difficult 10 years, obviously, for if you work for a company or you've got your own business, you'll know that there's been a lot of economic upheaval since the GFC. And what happened was, in terms of the tax take, a lot of companies incurred huge losses. For example, Qantas, had billion dollars worth of losses. And what happened in those years, over the last 4 or 5 years, those losses were gradually absorbed. Okay, so many of the companies that had really large losses in the GFC have absorbed those losses, and they're now starting to pay tax. So the cycle of the economy shows that improvement in the budget, probably because those companies haven't paid tax and now paying tax. There's been a crackdown on multinationals, and the economy is starting to recover after about 10 years of very, very, very low interest rates. So if that continues, we're going to have a completely different decade in the next 10 years, where we actually see budget surpluses as the world economy is going to be probably a bit stronger than it was in those last. We're entering a different phase, probably in our economic cycle, albeit we haven't had a recession for nearly 30 years. We're certainly going to be generating more revenue for government to be able to spend and allocate on our behalf. If we go to the next slide, I think this is really important for all of us in the economy. As we know, we've all got to balance our personal budgets, and our goal personally in our businesses is to always reduce or eliminate debt. With these budget surpluses, we will be looking on current projections to repay that debt we've incurred, which was about a net debt of about $373 billion. We've actually looking at paying that off by the year 28, 29. So let's hope that economic conditions stay up so we don't basically push that debt, I suppose, down the track for other generations to try to pay. So these were some of the assumptions behind the budget document. Now, getting into the nitty-gritty of tax and some of the really good things announced, we're going to the instant asset write-off, and it's really, really good for business, and it's very important that I say from the outset, you've got to be registered for GST, and you've got to be actually conducting a business to get these instant asset write-offs, and they have been enhanced. They've been getting extended every year for the last couple of years, and the instant asset write-off, as you can see on the screen, was $20,000. From the 29th of January, that actually increased to $25,000. So if you'd bought any assets and you qualified in the last few months, and the asset was under $25,000 plus GST, if you're registered, of course, then you get a $25,000 write-off straight away. Now, since budget night, that's actually going to increase to $30,000, and you can see that's going to go from budget night right to June 2020. So really good for small, medium-sized businesses, and really as well is that definition of the small business, which will be eligible for these particular concessions, is going to change from 10 million to 50 million. That would certainly capture most small, medium-sized businesses in the country. So lots of opportunities with asset purchases. Of course, it applies for every asset purchase, so just not in total. So you could be buying second-hand equipment, you can be buying new equipment, and providing each individual asset is under that 30,000 plus GST, you'll get an immediate write-off. So really good announcement, and never seems to be getting put in stone forever, but at least till 2020, we should have that $30,000 reduction. Also, when we go to the next slide, our personal tax rates, lots of announcements there, and just to try to simplify those announcements, the government's actually increasing the size of the low-income offset, making that available to June 2022. And it's going to increase from $530 to $1,080, you can see there on the slide. And really, the primary taxpayers who are going to get benefits are taxpayers between that income of $48,000 to $90,000. They're going to get the full offset. And for example, if it was a husband or wife, they would both get that offset. After their incomes, however, start to get above 90,000, then that starts to phase out to $126,000. So I know in the papers you were probably reading lots of different examples of, single income, dual income families, etc., and what taxpayers might receive. But you can see there, families may receive about up to $2,160, and that's for the current financial year. So this has been brought forward when you put through your tax return this year. So you may be immediately $2,000 better off, just depending on what your incomes are. So I suppose that could be said by some as an election sweetener, but certainly families will be getting that money. Family singles will be getting that money in their pocket straight away. Let's have a look at so that's short term. Let's have a look at a little bit more of the medium term. And if you're confused about tax brackets and tax rates at the moment, you'd probably be with most Australians. There's been a lot of announcements. I'm just going to try to unpack this and make this as simple as possible, right? Because what had happened in the last 12 months is the government had actually got through the legislation of significant tax cuts for personal individuals and companies up to the year 2025. So, of course, that's a long time in the future, but at least it's painting a picture of where the current government's trying to take our tax brackets and our tax rates. And you can see there, what's been announced is really from 2022, so it's still a couple of years away, that tax bracket that ends at 37,000 will be increased to 45,000. Now remember, it was already legislated to go up in that year to 41,000. So really, currently, you don't pay any more tax than 19 cents plus the Medicare levy up to 37,000. Legislated in 2022 to go to 41, but budget announcement 45. So let's see what happens in there long term. You can see that 32% tax bracket from 2024 is going to be reduced to 30%, right? So this is really significant because that's currently been earmarked to be in conjunction with the abolition of the 37% tax bracket. So what's already been legislated, of course it can be repealed, is 32.5 cents in the dollar from 2024, really all the way from just over 40,000 right up to 200,000. So this bracket creep, which occurs when taxpayers' incomes goes up, is going to be less and less if that gets through and stays in its legislative form. The abolition of the 37% tax bracket, as I said, is already legislated. So if we go to our next slide, it gives you an idea of an actual table that you can take away and have a look at, and it will give you really what's going to happen in those next year, the year after, and really over the next 5 years. You can see the bottom there at the screen. If that continues, you are going to see a flat rate of tax between $45,000 and $200,000, and I think most of us would probably understand that's almost everyone in the economy. So it really, most people will not be paying more than 30 cents in the dollar plus the Medicare levy. So your tax take on your personal returns is going to be less than a third. So that's where the government's trying to take us in terms of tax rates and thresholds, etc. All right, let's go to the next slides. There's been also some announcements about the Medicare levy low-income thresholds. For those that don't know, under a certain amount of income, and you can see there on the screen the thresholds, singles and families and pensioners, singles and families, and there's obviously an addition for dependents. You don't pay the Medicare levy. So that gets gradually increased every year, most of the time anyway. So you can see there, those thresholds where you're not paying Medicare are going to be gradually increased this year. Okay, so Medicare levy, and let's go to company tax rates. If you're confused about this, you'd be all probably with most businesses. We still get lots of questions asked about company tax rates. This table actually tells you where we're going, right? Now, right now, the company tax rate is 27.5% for turnovers up to 25 million. However, if your company has mainly passive assets in their assessable income, you still pay 30%. Right? Commonly, misunderstood concept, companies with passive income of more than 80% in their total, 30% tax. Genuine business companies, 27.5%. Now you can see there, at present, it's earmarked that these changes would then apply to the $50 million turnover companies at the 27.5%. You can see there in the table on the second line. And 2021, we're going down to 26%, right? And down to 25% after that. So, look, these tax rates are obviously being changed in response to, America and other countries with their tax rates and what they're looking to do to be well competitive on a company tax scale. So by 2021-22, most companies will not be paying more than 25 cents in the dollar on their company tax, and that will apply to 50 million. Okay, Labor has announced it probably will make some changes if elected, but at the moment that's where the company tax rates are. All right, let's go to some other items in the budget documentation. Superannuation, the work test, some changes there, and you can see there on the screen what the work test. Over 65, you've actually got to prove that you're doing some work, that is 40 hours over a continuous 30-day period, and that's been increased from 65 years old to 66 from 2020. I only see that going up in future years as the workforce actually works longer into their lives. So, but at present, 65 to 66, so there might be some opportunities for our clients who are between 65 and 66, particularly if they've got passive capital gains and want to put some of that income into superannuation, for example. So there'll be a lot of planning probably done just around that 1 year. Also, you can see spouse tax offsets, and that's really looking at eligibility to go from 70 to 74 years. So, and that offset is available, or a higher income earner contributes for a spouse who's a lower income earner up to 37,000. They can contribute up to 3,000, and the higher income earner gets a tax offset of $540. So you can see there generally the way ages in terms of what people are eligible for in this area are actually able to get. So some good announcements there. I can't say anything negative in those announcements. Remembering we're concentrating on tax, there's lots of things you can probably drill into, but I just thought I'd talk about a little bit for our business clients. Many of those would employ apprentices. There's been a $500 million skills package offered, and the government will actually fund an extra 80,000 apprenticeships. Employers will be paid an $8,000 incentive payment, right? And then the apprentice themselves gets paid $2,000. So really good incentive to continue to have more and more apprentices come through our system so we don't have a skill shortage. Also on our next slide, you can see infrastructure, which is really lots of infrastructure projects going on. Probably annoy most of us if we live in capital cities, but you can see another $7.3 billion announced for new rail and road projects, and there's $100 billion of infrastructure pipeline planned over the next 10 years. I think that's great government spending. And there's all sorts of talk about upgrading regional rail, road assets, feasibility for high-speed trains. Won't it be great when we actually build one day? And then a $3.9 billion drought fund, which I think is really significant given what our farmers have gone through in recent years. Going to the next page, there's other budget changes as well. Additional expenditure on aged care packages, won't go too much into that. I will touch base on our single touch payroll though. There's significant changes from the 1st of July in the way we report employees' wages, and so that's going to continue to be expanded. So if you're not really using software for wages, probably a time to get onto the appropriate software and do that, because really it's going to be very, very difficult, if not impossible, to have your single payroll system going without that. So more changes announced on that. I think that whole area is we're going to be moving towards a stage where probably superannuation will be paid at the same time wages are paid. So certainly there's a push in some quarters for that. Energy assistance for low-income earners, I think that would have been talked about lots in the media, so I won't go too much about that. And expansion of super stream, including income sharing between employers, super funds and the ATO. Whenever you hear of more income sharing between anyone in the ATO, you know there's going to be more audit activity to make sure that employers are complying with their requirements, and that really fits in also with what's going on with the single touch payroll. All right, so they're the main budget changes that I'm concentrating on today. Then I wanted to try to, so this is really hot off the presses really from some of it from last night, and what I wanted to do was to try to unpack what might happen if there is a change in government, because all of our clients should always be looking at if there's a change in government, what impact might that have on my business or might it have on my properties, etc. So what I've tried to do is just simply unpack what Labor's announced, not only in the budget reply, but some also other really important announcements about 2 weeks ago in relation to negative gearing and capital gains tax discount. So looking there on personal tax rates, you can see there the Labor, if elected, are not going to allow some of these additional stages of tax cuts to come in, and there's like stage 2 in 2022, so they're not going to let that threshold increase from 41 to 45,000, and they're not going to let the 32.5% threshold increase from 90 to 120,000. So stage 2 is gone if Labor's in. Stage 3, which involves the flattening of the marginal rates between 90 and 200,000 from 37 to 32%, or announced in the budget at 30, is not going to happen, right? So you just need to be aware of that. What it means, if you go to the next slide, you'll see compared to the budget, you can see 19% tax bracket, as I said, 37 to 45,000. Basically, we're going to be back still at the old 37,000 tax bracket in 2022, and then really that reduction to 30%, 32% is going to be abolished, so there won't be any 30% reduction, and that 37% tax bracket will stay as is. I've tried to put this into a chart on our next page, and just to give you an idea of what might happen. So probably best to look at that when we send out our budget update. It'll be posted on our website, of course, and we can email that as well. But you can see there, I've tried to just outline what changes which have been proposed by the budget and are currently in place which won't be implemented. So you can see there that those 2022 changes where we're looking at different thresholds increasing to avoid bracket creep are not going to go through. And there at the bottom of the screen, you can see the new thresholds from 2024, 25, and the reduction of brackets, to a more flat tax structure is certainly not going to occur. So just important when you're doing your planning, just to be aware of what might happen there. Some other things too on Labor's budget reply. You can see there lots of money for Medicare cancer plan, which I think we'd all agree is always good, given it's one of our biggest killers in society. And you can see there $1 billion on 150,000 extra apprentices. So we'd always welcome that because of the skills shortage. Also, too, what was announced is $400 million to boost women's super balances. That is, superannuation will now be paid, if elected, Labor government's elected, on parental leave. So I can't see anything but is good in relation to that. Probably what might be a little bit more contentious is on our next screen. So they're the budget announcements, post-budget announcements. But the pre-budget announcements, I think, are the announcements which are really going to have an impact on us if they come through. Now, I've had lots of talks with our clients about this over the last 6 months. We knew it was going to happen one day, that one side of politics is going to make some or propose significant changes to negative gearing. Let me go through those. If the Labor government is elected, they have said that they're going to abolish negative gearing on second-hand properties exchanged after the 1st of January 2020. So we now have a date. It came out in the last week or two. If you've been away, you missed that date. But you can see existing properties are going to be grandfathered, right? So this is important, that you will now have a slightly different tax treatment for a pre or a post 1 January 2020 property if it's second-hand. Also, the capital gains tax discount is going to be reduced from 50 to 25% from 2020. And also that is, apologies, it should be on there, that is going to be grandfathered as well. So you will receive the capital gains tax discount if you purchased a property, for your current properties really. And also abolition of borrowings in self-managed super funds. Again, it would be grandfathered as well, but after this date, you're only going to be able to buy properties in self-managed funds if you don't borrow. Okay, now remember, this is not only applying just to properties, it'll apply to all investments. So there's some really significant changes there. Just in terms of 100 grand capital gain, at the top marginal rate, that'd be about 23, 24 grand. This change is going to mean that the tax on that 100 grand may be up to 35 to 37 grand. So you can see quite a significant change with the capital gains tax in particular. Okay, now what does this mean? Because this is always the question, isn't it? I've come up with a few ideas that you mightn't have thought about. Current properties may be more valuable from a tax point of view. What do I mean by that? They're going to have better tax benefits. Once those properties have been sold and you're on the new system with a new property, you're not going to get the same tax benefits. For those many clients of ours that use our wealth management and know how much work we do on properties versus super and getting the right balance, it's going to become a lot more complex because some properties may have a capital gains tax discount of 50%, and some may only have 25%. What that might mean is that you could sell properties in retirement which have less tax, right? That is, sell your pre-January 2020 properties as opposed to post-January 2020 properties. Sounds a little bit like some of the things that were in place pre and post capital gains tax when it was first brought in. So there's certainly going to be extra complexity from a tax point of view and extra complexity from a financial planning point of view. So, look, I think that rounds up most of the proposed changes. I know there's probably other things in there we just can't cover today, but I just wanted to thank you for attending this webinar, and I think we're going to have a little bit of time, at least 5 minutes for questions. And I'm sure you've got, if you don't have questions right now, certainly you can email us, talk to us about questions, and certainly for our business clients, we've got tax planning meetings coming up. We've also got tax return interviews and variations going out at the moment, so lots of opportunities to talk to any of our client managers about this. Questions?
Fantastic. Thanks very much, David, for that. So just while people are typing in their questions, just a couple of other things I'd like to let people know about as well. So as mentioned earlier, this webinar has been recorded. It will be available online after the session. So keep an eye on our social media accounts and on our website, and also make sure that you've downloaded our app as well so you get that notification when it is available online. As David mentioned, single touch payroll is a very important aspect for a lot of our business clients, particularly those that have payroll. We will be doing some webinars to talk about the single touch payroll requirements in the coming weeks. So if you are interested in joining any of those webinars, make sure that you drop us a line there at info@wscgroup.com.au to register your interest, and then we can let you know when those dates have been locked in as well. As David mentioned, good time to schedule in your tax planning meeting for business clients coming into 30 June as well, just to talk about how the budget changes could impact on your business. And for property investors, just a reminder that tax variation time is close upon us as well. So again, keep an eye on our website and social media and our app so that you get your tax variation checklist when that is available. Okay, it looks like we don't have any questions today, so if you do have any questions after the event, just drop those through to info@wscgroup.com.au and we will be in touch. David, did you have anything further you'd like to add?
I just want to say thanks for coming. I really appreciate the time that obviously any of our clients put in for these seminars, and more than happy to ask any questions. I just appreciate the attendance.